Welcome to today's NIC Leadership Huddle, Fact or Fiction, Lending Markets During a Pandemic and Beyond, the second leadership huddle of our 2021 series. I'm Chuck Harry, NIC's Chief Operating Officer, and I have a few introductory comments ahead of our panel's discussion. NIC thanks NHI for sponsoring today's leadership huddle. It's through sponsors such as NHI that in large part, NIC is able to provide a forum for education and discussion about the efficient flow of capital in seniors housing and skilled nursing, therefore enhancing transparency as well as access and choice for America's older Americans.
Welcome to COVID Fact versus Fiction. I'm Michelle Kelly, Senior Vice President of Investments at National Health Investors, or NHI, and we're really pleased to sponsor today's Leadership Huddle. NHI is a long-term, relationship-focused investor who provides creative financing solutions for both acquisition and development to senior living and skilled nursing operators across the country. If you'd like to learn more, please check out our website at nhireit.com, and we really hope that you enjoy today's webinar. Thank you.
NHI. A quick reminder that if you need to adjust your audio for today's webinar, you have joined the webinar using either your computer's speaker system or your phone based on your audio access during your most recent GoToWebinar session. You can adjust your audio to today's webinar through either your computer speakers or your phone using the settings in the audio pane, which is located on the top of the control panel on the right side of your browser window. And with that, it's my pleasure to introduce our co-moderators for today's webinar. Joel Mendez, Senior Director, JLL Capital Properties Seniors Housing, and Jim Thompson, Senior Vice President, Director of Senior Housing Investments, BOK Financial. Jim and Joel, we look forward to the panel's perspectives on the facts and fiction within the lending markets during this pandemic.
Sorry to interrupt. Rob, is your audio coming through? Are you muted?
My audio is not coming through. I cannot hear Joel.
I can't hear Joel either.
Yeah, Joel. It shows you're unmuted, but we're not hearing you, Joel.
Maybe, Jim, if you could just proceed.
Absolutely. I think I'm sure that I'm not going to do this as Joel would have done it, but basically I want to thank obviously NHI and obviously this panel for agreeing to participate in this discussion this afternoon about the debt markets during the COVID pandemic. As you can see, today's speakers, Rob Chapin is the Chief Executive Officer of Bridge Senior Housing Fund Manager, LLC, and Steve Schmidt is National Director of Senior Housing for Freddie Mac. And everybody on the call today is hoping to provide some insights into what happened with the debt markets at the start of the pandemic, what has changed over the course of the pandemic, and what we see for the future. So with that, since we have a little time, why don't we get started? I'll ask the first question of Rob. Rob, fact or fiction, throughout 2020, COVID has reduced interest from prospective investors in your senior housing funds?
Yeah, thanks, Joel and Jim. I appreciate the opportunity to also be on the panel with Steve. And you know, I think that's a hard fact for sure. Obviously, you know, investor capital flows came to a virtual standstill toward the end of the first quarter as we all started to embrace the impact that this pandemic was having, you know, across the country, really across the globe. You know, most of Q2 across all of our investment types, both fixed income and equity, pretty much we're non-existent in terms of investor appetite and interest. So not to say it's isolated to seniors housing. I'd say it was a very broad kind of hard stop for investors until they really started to understand and quantify the impact, having broadly speaking. So we essentially shelved our new seniors housing fund for the first half of the year. We focus, as most probably on this call, operators and owners did, on the operational challenges that we all confronted with COVID-19. So, we started to see a small crack with investor interest open up, call it 10–15% of our normal flows, and really kind of cranking up towards the middle of the third quarter and going into the fourth quarter. As we started to see the impact of the virus start to abate a little bit, we started to see a bit of the uptick of the virus in that second wave, which again, continues to, I think, have somewhat of an impact, at least in our sector, on investor short-term interest as it relates to understanding the impact to the sector, both from a current perspective and a longer-term perspective.
Great, thank you, Rob. And now to Joel. Fact or fiction? Non-recourse acquisition financing in 2020 was a challenge and materially impacted valuations.
Well, fact or fiction, Jim? Can you now hear me?
Sure can. Thanks, Joel.
Oh, fact. Okay, good. I don't know what happened there. The question you just asked is mostly fact. According to Collins Dictionary, the word of the year for 2019 was climate strike, which apparently was used more than 100 times as often as it was the previous year. I would like to propose the phrase of the year for senior housing debt for 2020 was hit the pause button. And if you didn't hear that, you might have put the dictionary side, open up the thesaurus, you might have heard the synonyms of that, which are focusing on asset management, or servicing existing clients, or just trying to figure out what the heck is going on. And we saw that mostly in the second quarter of last year, but kind of throughout the year as well. Permanent lenders like Freddie Mac, Fannie Mae, the Life Cos were still very much in business, and terms were a little bit more conservative, but still attractive, particularly the low interest rates. But, and this is key, in-place cash flow had to be there to support the loan, which is how the permanent debt markets have always functioned, not just in senior housing, throughout all asset classes. So what happened is that as the months ticked by in 2020, fewer and fewer deals underwrote for permanent debt, and which has continued through to today. And there are certain buyers who will not execute a transaction if they need to model a refinance in the middle of the investment period, meaning that bridge loans are not attractive to them. And that reduced the buyer pool. The rest of the buyer pool needed to rely on bridge debt, and the non-recourse bridge debt market, which is now quite mature and liquid, did not fully materialize until later in 2020, as lenders became more comfortable understanding the risk ahead of them.
Terrific. Thank you, Joel.
Steve,
Yes.
fact or fiction? Freddie Mac's portfolio has fared well during the pandemic.
Well, I would say that is relative to what we've heard from other lenders. That is predominantly true. But we certainly saw a lot more stress in our senior housing portfolio, and I would say a lot more stress, importantly, than we saw during the global financial crisis. We at Freddie Mac, this is across our multifamily platform, but it applied to seniors housing also. We proactively instituted a 3-month forbearance program during the height of the pandemic, which a good number of our senior housing borrowers availed themselves of. The rate of uptake of that senior housing loan forbearance for seniors was roughly twice that of our multifamily portfolio. So within Freddie Mac, relative performance, one could argue, was definitely weaker than multifamily. The good news is the vast majority of those senior housing loans that took forbearance are now paying current, including repaying 12 debt service payments that were deferred, and they're repaying that over roughly a 12-month schedule. So we feel the program provided the necessary relief during the worst part of the pandemic, and we feel very good about that and how we supported our borrowers. We have had several senior housing loans go into special servicing, which is basically means that they're defaulting or soon will be defaulting in 2020. And that was, we only had 2 loans from 2015 to 2019 that actually defaulted. So it gives you a little bit of sense of the difference. So although that's not great news, I would say based on what we've seen and read, that's a lot better than a lot of our senior housing lending peers. You know, I've heard upwards of certainly double digits, 20, 30, 40 loan defaults. In certain cases over several $100 million of loan defaults. We're nowhere near that at this stage, thank goodness. So altogether, there's still a lot of stress in our senior housing loan portfolio, but I think we have been very focused for the longest time on strong sponsorship, and that means both borrowers and operators. And I think those people have been able to weather the storm so far. So we feel pretty good about that and hope that can continue, but it remains to be seen.
So Jim, thank you, Steve. Fact or fiction? Bank regulators made it easier for lenders to forbear and extend loans in 2020.
Oh, absolutely a fact, and Steve alluded to it as well. A couple of noteworthy things happened in March of last year. The CARES Act included some relief to financial institutions with respect to classifying troubled debt restructures or TDRs. And typically in the past, if you had to defer interest or principal and interest payments, that would nearly always put you in a TDR category and have a negative impact on your capital. The regulations gave lenders up to 180 days for their borrowers to defer these payments. Some lenders just went with the 180 days out of the chute. Others took it in 2 90-day increments, which sounds like what Freddie Mac did. It's what our bank did, and after that first 90 days, the vast majority of folks were back on track, so it was successful as well. But in addition, the Federal Reserve provided guidance that the examiners to the institutions would not be overly criticized if they work with their work with their borrowers who have been impacted by COVID-19. So you had a couple of things really working in the borrower's favor early on in the pandemic.
So if we sort of dig through some of the acronyms there, that means that the banks did not have to hold as much capital on their balance sheets for deferring loans as they would have for the same amount of deferrals in 2019.
Correct, which was very important because the bank's capital calculations changed dramatically at the first of the year, so it would have been kind of a double whammy. Same thing with PPP loans. No, the banks did not have to, hold additional capital for those as well. It's a very similar approach.
So during the volume mishap in the beginning of this panel, I was going to explain those first 4 questions were about 2020. The next 4 are going to be about what's going on right now. The 4 after that are going to be what the near future holds. And if we can get to them, the last 4 are more forward-looking. So Jim, I'll turn it over to you to pose the next fact or fiction question about today.
Great. My next question for you, Rob. Fact or fiction, the debt markets are a hindrance to your desire to buy and build new assets?
Yeah, I mean, specifically for us here at Bridge, it's fiction, I think, and that's the case for most well-resourced platforms that have demonstrated the ability to stay on top of operations and drive the right outcomes during the pandemic, stay close to their lenders, really brought them in under the tent as it relates to how they're working through the challenges of COVID, reduced net operating income because of lost occupancy and increased expenses and things of that nature, and how you're working through that. I think lenders really appreciate that partnership with us as owners and operators, et cetera, and understanding the dynamics that we we are challenged with, and work together to again drive the right outcomes. You know, at the end of 2020, you know, we did go out to the debt markets and a few times, obviously not at the pace that we did in 2019 or expect to in 2021, but we had generally very pleased with the response from the lending relationships, and we anticipate that we will continue to have very good outcomes with our lenders as it relates to refinancings, new acquisitions in 2021. Obviously, the conditions of underwriting are somewhat dynamic and somewhat, I think, property dependent. For example, stabilized properties, are more difficult to acquire right now because of tighter underwriting constraints. And Steve can certainly speak to this from the agency side of things. But what we're generally seeing is more conservative underwriting on debt service coverage ratios, lower LTVs, increased underwriting expenses for PPE, labor, insurance, and all the typical things that we're all experiencing right now that have to be factored in as we look at what realistic cash flows are going to be to service our borrower relationships. So we don't anticipate, at least right now, for 2021, any new ground up development projects, but we are looking at some stuff that would be shovel ready for 2022, and don't anticipate having any significant or material challenges in the lending market on that side of things.
Thank you,
Rob,
Rob.
I'm curious. Your creditworthiness as a borrower, I'm sure, has always helped you acquiring assets when compared to maybe some other groups bidding on them. Do you feel as though that is even more of an advantage now than it was before, or about the same?
I think certainly having a strong credit profile is critically important in good and bad kind of economic cycles. I think the more important thing for everybody is, as I said earlier, is really bringing and treating your lenders as your partners in your business. They're critically important to the overall success of your investment and your operational success. We work here at Bridge with really under the thesis of bad news doesn't get better with time. We like to kind of get out in front of challenges and problems in advance of them becoming bigger problems, and bring our lenders into that to help us work through those things and understand where the opportunities are to do that. And I think as long as you're doing that, whether you're a super strong deep credit or someone who maybe is a middle market credit, you can still have, I think, some good outcomes. Speaking as a borrower, but I think always engaging and having very, very strong relationships with your lenders is critically important to driving that success overall, Joel.
Terrific, thank you, Rob. I think the keys to lending anytime or ease of lending anytime is adequate capital to support the operations, but more importantly, good outcomes and good operators. And those are even more important today than they historically have been. Joel, a question to you in the current category, fact or fiction, new development financing terms are so conservative as to render them non-existent?
That is fiction. We closed new development debt financings all through 2020 and continue to do so today. But before we talk about what those deals look like, I think it's worth noting that new development had slowed even before the pandemic began. And that is in part driven by hesitancy from both debt and equity providers. The pandemic certainly accelerated the decline, but underwriting was already tightening in 2019 and heading into 2020. And we just saw more of an exacerbation of that existing trend. So the deals that are closing now have some commonalities amongst them, and none of this is going to be surprising. Strong sponsorship is probably number one. Solid, which includes alignment with an operator with a local presence, solid sites and high barrier to entry markets. All of these were considerations prior to the pandemic. If I had to pick one financing term that has changed the most since March 2020, I'd say it's recourse. Lenders are requiring more of it, and non-recourse debt financing, particularly that starts with a 6 on the loan to cost, is pretty hard to come by. But again, the trend towards requiring more recourse was already occurring pre-pandemic. And if you've got a solid project, then you can get financed today. There's no doubt about it. Again, it's solid.
Terrific. Thank you, Joe.
So, Steve, looking at this question, I would argue this is a little bit of a softball, so I hope you hit it out of the park. Fact or fiction? Freddie Mac continues to quote new deals with attractive terms.
Yeah, well, I'm clearly biased, but I would say that that is true, provided borrowers can work with the lower leverage that is present today. Senior housing mortgage rates are near all-time lows. Our senior housing loans are securitizing very well, which means we can offer very attractive rates. And there's still positive leverage between cap rates and mortgage rates. So that normally would suggest a good financing. We honored all our commitments and continued to lend on senior housing even during the worst days of the pandemic. And we believe that we actually lent more than any other lender in this space in 2020. So, we continue to be bullish on seniors housing, continue to lend. And I think hopefully that volume is a testament to that. Please note, you alluded, some of this I'm going to be a little repetitive to what you were saying, Joel, but Freddie Mac's always been a cash flow lender, meaning we only underwrite and lend on sustainable cash flow in place. Anything else is more of a bridge loan scenario that a bank or a bridge lender would do, and that's just not what we do. COVID-19, however, made that sustainable part untenable. It's not sustainable. So we had to pivot. We basically had to adjust our underwriting vacancy assumptions to kind of see where things were headed. And we basically have done two things. One, we typically would, we're doing a little less these days, but we would underwrite maybe 3% lower occupancy than the rent roll showed. And we also put in place one-year debt service reserves because we really wanted to make sure that, no matter when the second, third, or thank God, not the fourth wave comes, that the loans would be able to sustain it. Now that we're seeing most of the communities having received certainly their first dose of the vaccine, many have received second, and there's some that have even had all three clinics done. We're hoping it'll probably take a couple of months, but we're hoping to see some green shoots of, more tours, more move-ins, good occupancy, hopefully some relief on some of the concessions that we're seeing in the market. And that's going to enable us to open up and make the financing even more attractive. We'll be able to loosen some of those. We can probably more or less, as long as we start to see a nice sustainable upward trend, we're not going to underwrite to a lower vacancy, and we'll gradually begin to reduce the debt service requirements. And I would say lastly, just as a comment, loan to value is less meaningful right now, at least from a permanent lender standpoint. Anecdotally, it appears values have only dropped 5 or 10%. We're not seeing huge discounts taking place in the market, and NOIs have certainly dropped a lot more than that. So really what's constraining proceeds today is debt service coverage, not loan to value. I can't tell you how many deals we see where, the normal relationship between loan to value and debt service coverage is kind of out of whack. And that'll probably continue for some time until we can get more return to normal levels of occupancies and NOIs.
That's pretty much flipped upside down from historical.
Yeah. There's been a fair amount of lack of normalcy, which we hope will return at some point. Jim, fact or fiction? The conventional bank lending markets have opened up considerably in the last 90 days.
I would say that's true, Joel, but it's not happening across the board. The banks that have had a long-term presence in the market, have experienced staff. Those are the ones that not only have been active through the pandemic, but as we're coming out of it, are eager to do more business. And that doesn't describe every senior mortgage lender that has been in the space lately. And I see this being driven by several factors, and not the least of which is what Steve mentioned, which is the vaccine rollout. The last numbers I saw was just under 5 million doses in long-term care settings. Many facilities have or will soon have their second clinics, and a lot of them will probably be done with a third by early to mid-March. So that's all very good news. But lenders have also gotten a better idea of what the downside is to occupancy and EBITDAR. There's a lot more comparative information available related to COVID from CMS, CDC, state health departments, and lenders are learning what to ask when it comes to underwriting and due diligence. And I see more lenders willing to sort of dig in and do the due diligence than earlier in the pandemic. And, you know, it's early in the year, so from a practical standpoint, you know, lending groups have loan growth goals that they have to deal with. In terms of pricing and structure, like Steve indicated on the permanent side, I think that structure is holding the line, at least for now. And it's pricing that has begun to move in and starting to get closer on an all-in basis to sort of pre-pandemic prices. And that's my view of kind of how the traditional debt markets are functioning right now.
So Jim, off script, fact or fiction, coming out of a down market, pricing comes in first, then structure, from a conventional bank lending perspective.
Yes, fact. I think some of the things that we're starting to see that I mentioned earlier have to be a lot clearer, and for most of the banks to really start making fundamental changes in leverage, especially, you know, cash flow leverage based on recent historicals and things like recourse levels and burn downs or burn offs. I think that will lag the pricing.
I agree with you. I think that's what we've seen in the various cycles you've been through.
Right.
Now we're on near future. Jim, you want to kick us off?
Yeah, absolutely. Again, to Rob, fact or fiction, you expect discussions, and I think you alluded to this earlier, so feel free to elaborate, but do you see discussions with lenders related to underperforming assets being more challenging in 2021 than they were this past year?
Generally, I think that's fiction, Jim. I think, you know, we have found nearly all our lending relationships to be, you know, understanding and proactive with the pandemic's obvious impact on our lending relationships, on our assets, and broadly speaking, just in industry wide. You know, while we expect, you know, some great improvement, as mentioned, with the vaccination being rolled out, I don't think any of us really expect the industry to snap back immediately to pre-COVID levels in 2021. I think we're going to see some incremental progress going into Q2, and then that progress should build in Q3 and beyond. We should start to see more normalized operations. But I think, you know, we expect discussions to continue as is between our borrowers and the lenders and how we kind of approach it. Again, I go back to what I said earlier. You know, I think, you know, for any borrower that, you know, that really engages their lender as a partner, I think, you know, that goes a long way. They greatly appreciate the transparency and collaboration. And you know, in our shop, we call that cementing the relationship with the lender. You know, it's easy, obviously, to have great relationships and everything's going well, but I think, you know, lenders truly appreciate, you know, how operators work through a challenge. It's certainly an unprecedented challenge, like we are all engaged in here with COVID-19. So again, that for us has really been incredibly important, you know, in the context of how we are approaching our you know, our lender relationships, underperforming assets, if you will. You know, we have very few that are outperforming these days. So we have a lot of frequent discussions with our lenders, and I think we've gotten to know them better than ever before. I would say anecdotally too that we've had a couple of our larger bank lenders invite us in for lunch and learns with their broader credit teams to really kind of go through Q&A on our industry and how we approach working through and managing operating expenses and all the other challenges that we all have as operators in this industry. And that's been helpful, I think, as banks continue to expand their intellectual capital around the space and dig in deeper. And I think that's going to be, for all of us going forward, it's going to really create a better, capital markets environment overall as we look beyond the pandemic, which is going to be here before we know it.
Right. No, I'm with you. I hope that kind of transparency and information flow remains post-pandemic as well. Speaking from the lender side of the table, Joel, fact or fiction? The lending markets will improve throughout 2021, and getting into 2022 will be more borrower friendly.
I believe that's a fact. I think we're going to start seeing, as Rob just alluded to, upward trending performance towards the end of the second quarter of this year, which means that lenders will be able to underwrite this trend starting in the third quarter, early third quarter, hopefully. And something that's been a theme in the senior housing capital markets in 2020 and through to today is that in-place performance at the asset level is usually declining month over month. So you engage a deal in September, and come December, the numbers look worse, which has caused ongoing stress in the transaction process. So I believe what we'll see later this year is just the opposite. The numbers are going to start looking better as the transaction process progresses. And this trend, in my opinion, will be accelerated by the decline in construction starts and also combined with the growth in the 80+ demographic. And while we all know we're not in the middle of the baby boomer curve for senior housing, we're approaching the curve. And you might not believe this, but population growth for the 80+ demographic from 2021 to 2023 is projected to be more than twice what it was from 2017 to 2019. So those tailwinds, when you take into account the decline in construction starts, the demographic tailwinds are really going to start to accelerate. And from an equity perspective, dry powder in the United States for real estate in December 2020 was over $200 billion. And that's uninvested private equity, which is close to a record high. And for context, in 2007, this number was only $87 billion. And that it basically held that level through to 2013. So there is a lot more liquidity now than there was coming out of the global financial crisis. And what this means is that lenders can expect high quality sponsors with, like Bridge, for instance, with the ability to invest meaningful equity into transactions. When you take all of that into account, I think the lending markets going into 2022 are going to be very strong. So, Steve, the last one I served you up was a softball. This is not a softball.
Okay.
I'd love to hear your answer. Fact or fiction? By 2022, Freddie's underwriting criteria will be similar to 2019. This reflects the loan to values, debt service reserves.
Got it. Yeah, I think that is going to be predominantly true, and I would argue that a lot of lenders probably better hope it's true because there are loans maturing, so loans need to be refinanced also. But I would say, assuming COVID-19 is contained and eradicated, it's likely we'll underwrite pretty close to what we did in 2019. That being said, there's going to be some line items and some things that may not change. I'm thinking of things like higher insurance costs. I don't think we've seen a dramatic increase in that, and I don't think that's going away, in the next year or two. My hunch is that PPE testing and infection protocols will have to continue into 2022. We're hearing now it's likely that this country may need to have vaccines for 2 or 3 more years to fully eradicate COVID-19. Labor is kind of an unknown that possibly might continue to be higher. And I think it's, like we said before, I don't think it's going to snap back. I don't think we're going to cover, we've lost 8 or 9 points in occupancy. I'm not sure we can recover all that in 2021. So that will still be the case. But we'll still be underwriting cash flows in place and occupancies. And so to the extent, like you said, that if the trends are stable to increasing, we won't have to do anything in terms of having tougher underwriting occupancy assumptions. Debt service reserves will roll off. We are not planning, and nor did we during this whole thing. We never changed our loan to value or debt service parameters. It's just that the NOIs were so heavily impacted, and if you're kind of looking forward, even worse. So that's not going to change. We are absolutely going to have the exact same LTV and debt service parameters in today that we're going to have in 2022. So that will still be good. We're not going to, I certainly don't imagine that we or any lender are going to be underwriting for the rainy day of a resurgence of the pandemic. Once I think there's a good trend and the science has got it under control, I think we're gonna have to assume that this may not be a 100-year event, but it's certainly a 50-year event. So we're not going to do that. So I think things will look a lot better. I think we'll be a lot closer to 2019 kind of underwriting in 2022.
Great. That's great to hear. Jim, dovetailing off Rob's comments earlier with respect to lender-borrower conversations, fact or fiction, bank regulations will tighten in 2021?
I think for the most part, the answer to that is no. The same regulatory flexibility in the CARES Act was included in the December stimulus. So there's still 180 days worth of deferral and still the same approach with respect to classifying modifications or amendments as troubled debt restructures. The Federal Reserve hasn't changed their guidance. But there's, I think, a couple things to think about. One is the clock isn't reset for those who have had 180 days worth of payment deferral, so they're not eligible any longer. As Steve mentioned, and BOK had the same experience. The vast majority of folks after the first 90 days were back paying again. Now, whether all the covenants were in compliance or not is still another issue. So there's not a huge expectation, I think, on the part of banks and their risk managers to do a whole lot more of what was done early in the pandemic for payment of interest and principal. The other thing is that bank capital levels are a whole lot better than were expected early in the pandemic. And I think that just means that banks are going to be using and looking at much more traditional ways to deal with credits that are declining or credits that are actually considered a problem. So to the extent that you have credits like that, expect the actions taken on behalf of the banks to be much more traditional in terms of improving structure and or fees or whatever. They're going to look more like they were pre-pandemic than they were in the first part of the year.
That makes sense. All right, we made it to the future round, Jim.
We sure did. We've got, we probably got about 5 minutes to cover that. So Rob, back to you. Fact or fiction? Senior housing will have proven resilient through COVID, and you expect limited partnership equity markets in 2020 to be very favorable.
I do. I feel very strongly about that. We do. Obviously, as a company, we have to. But no, I think, from an investor's point of view, the sector still offers compelling long-term investment theses for sure. You think about, the pre-COVID challenges facing the sector largely have receded. And, I think it's already been mentioned, Joel, you mentioned it around development. The robust development pipelines, the labor shortages, those things have really abated significantly. And those were big challenges for operators and owners, going forward to have success in their investments. So, I think as banks continue to be very discriminate around their lending activities, the unemployment rate and unemployment in general still continues to, there seems to be a dislocation there. It's going to provide opportunities for us in seniors housing. You know, operators will have to recognize, and I think we are, the new normal, not revert back to the old normal, and continue to evolve. And I think that creates the real opportunity. I think the owners and operators that do that really well will attract a lot of investment capital going forward. But, you know, the facts of the demographic tailwinds haven't changed and are as compelling as ever. Product relevancy and validation coming out of COVID, in our estimation, is stronger in many ways than it's ever been in terms of how well we've cared for the most vulnerable cohort through this pandemic. So, you know, I think, you know, those are things that we can all really capitalize on. And I think, you know, just practically speaking, we would anecdotally share that from our perspective, you know, owning over 100 communities in 25 states, that, you know, as we track very, very diligently on a daily basis, you know, our inquiries, our leads, tours, move-ins, in many cases right now today, and because of the vaccine really getting traction, are starting to get back to pre-COVID levels. I can tell you from an investor's perspective, the senior housing sector, you know, I think represents all the attractive elements of essential needs-based real estate, which, you know, will have a very strong appeal for the long term. So nothing's changed. I think our industry, if anything's gotten stronger and better. We're better positioned than ever before, I think, to handle, you know, these types of crises. And once again, we can, as we did during the global financial crisis, I think, point to a lot of bright spots that we did very well. You know, as investors look at this sector and as a place that they want to place capital. So I think we're very bullish on the long-term capital inflows in the seniors housing industry.
Agreed. Thank you, Rob. Joel, the new lenders that came into the space during the pandemic, are they here to stay? And who are they?
I believe that's a fact. The new lenders you're referring to are mostly outside of the conventional banking market. And these are debt funds, finance companies that have found margin in what was a fragmented non-recourse debt market in 2020, I had alluded to earlier. They spent time and resources building, adapting, and educating teams. And I believe they'll find the senior housing debt business is an industry that they want to be in long term. I also think over time, with a track record of successful loans, the interest rate spreads being offered by these new entrants are going to start to compress as well. We have Chuck Harry on the screen. Hey, Chuck.
Hello, Chuck.
Hey, guys. Have you managed to get through all the questions at this stage?
We got through the main questions. The bonus round questions we won't have time for. Maybe we can do another one of these.
Or you want to do one bonus round?
Oh, we can do that.
Or I can wrap. I wasn't clear. How about we go ahead and wrap? Because I think you guys have done a great job of separating for us that fact from fiction within the lending markets during last year, this year, and beyond. We welcome you to join us on Wednesday, February 24th at 2 p.m. Eastern, 11 a.m. Pacific for our next leadership huddle on the skilled nursing sector's short-term and long-term operational challenges and their impact on valuations, and a discussion with Colleen Blumenthal of Health Trust, Ben Reisman of TL Management, and Wendy Simpson of LTC Properties, Inc. On behalf of the National Investment Center for Seniors Housing and Care, otherwise known as NIC, as well as Joel, Jim, Rob, and Steve, thank you for having joined us for today's Leadership Huddle. Please stay safe, maintain your physical distance, but keep connected. This concludes the webinar portion of today's Leadership Huddle.